Treasuries climbing for a third day after Russia's finance minister said he has confidence in the U.S. dollar and his nation has no immediate plans to switch reserve currencies. Also weighing is a report out today that showed foreigners slowed purchases of U.S. securities and that China, Japan, and Russia had trimmed their holdings of Treasuries in April. To help make sense of all of this, let's introduce our next guest. He was the top-rated analyst for Treasury inflation-protected securities last year. Michael Pond, interest rate strategist at Barclays Capital, joining us from his office in New York. Thanks, Michael. Appreciate the time. And let's start with your reaction to what we're seeing out of the Treasury market this morning on the back of those comments from Russia's finance minister.
Well, Treasuries are rallying, really just a continuation of a rally that started last Thursday after we got through a pretty big glut of supply with 3s, 10s, and bonds last week. The market was able to absorb that supply, touch off that key 4% level without breaking through in any significant fashion, and investors started to come in just as that 4% was really a trigger point for many. Obviously, there's been a lot of concern over the past month or so about the potential for a significant slowdown in Treasury buying by foreigners, and comments last week by officials out of Japan and then again overnight from Russia have just continued that rally that started last week.
So at this point, then, should we assume that those concerns over all the fresh supply in the Treasury market have pushed to the sidelines then?
Not at all. They're not done. We continue to get pressures on both sides of yields, and the main theme over the past month has really been about volatility in the 10-year note. Every 2 weeks we get supply, so we tend to cheapen up into that supply and then rally thereafter. You have continued pressures from the economic front, but it's not clear that that's going to be a straight line up either. As this morning's Empire data showed, this week we get quite a bit of data out from housing and on the inflation side. Very important, as some are still in the deflation camp, which we think is highly unlikely. And then next week you have the FOMC meeting. So there's plenty of factors to keep Treasury rates volatile here.
So what does that mean? Is this a trader's market for Treasuries? Is that what you're saying?
Well, we think the best spot to be in is in the front end. That's where we have the most conviction. Longer out, there will be a decent potential for investors to catch short moves, either up or down. So it is a trader's market at the longer end of the curve. But on the short end of the curve, we think there's a more fundamental factor at play, and that's that the market has just priced in too many hikes too soon. There's just way too much slack in the economy for us to be expecting the Fed to move up the Fed funds anytime in the near term. We expect the Fed to be on hold really all the way through 2010, and yet the market has priced in hikes as early as December.
Michael, we've got about 10 seconds left. I just want to get your take on where you see the 10-year yield at the end of the year. Economists polled by Bloomberg see it around 3.65%.
We think it'll be over 4%. The Treasury is likely by then, even if they extend their purchase program, which there's certainly some debate there. We think it'll be slowing by then, and the economy will continue to turn around, and that should pressure yields to the upside.
All right, Michael Pond, we thank you for your time. That's Michael Pond from Barclays Capital.